Hey everyone, welcome back to Corporate Decoder, the place where we dive into company filings and uncover the real story behind the numbers. Today, we've got a filing from Diginex Ltd, and let's just say this one has more twists and turns than a pretzel factory's annual shareholder meeting. So, buckle up. Because we're about to decode the Diginex story, before we jump in, if you love getting these kinds of unfiltered insights from corporate documents, make sure you hit that subscribe button. And hey, we've got a fantastic community over on our Discord server that you can join. Link is in the description below. Alright, let's get straight into it. Diginex Ltd, which is a company incorporated in the Cayman Islands, but with operations mostly in Hong Kong, recently filed its annual report. This report gives us a look at their financials and business for their fiscal year ending the 31st of March 2025. First up, the top line revenue for the year was about $2 million US. That's up from $1.3 million US the previous year, so growth is happening. But let's break that down a bit. The software license fee part, which is a big chunk of their revenue, jumped to $900,000 US. That sounds great, but look closely. A lot of that jump came from a one-time deal for a white label version of their ESG software in Malaysia. The company expects the rest of their software subscriptions to stay pretty flat. Then there is customization income, which is where they build special features for clients. That income actually dropped from $700,000 US last year to about $460,000 this year. The company says they're doing this on purpose to focus more on their main software products, which makes sense, but it still means that part of their business is shrinking. Now, let's talk about the bottom line. The company reported a loss of around $5.2 million US for the year. That's actually a bit better than the $4.8 million loss last year, but it's still a loss. They've been losing money for years, with a much bigger loss of over $9 million US back in 2023. This means they're still a long way from being profitable. A big reason for those losses are the costs of running the company. General and administrative expenses were over $10 million US this year. That's up from about $9 million last year. A big part of this increase was professional fees for their IPO, which cost a lot of money. They also had some expenses related to issuing preferred shares, which sounds complicated, but basically means some costs popped up because of how their ownership structure changed. On the employee side, costs stayed pretty steady at around $4.8 million US. They have about 26 employees and 9 contractors. They did manage to cut down on development and maintenance costs, spending about $1.4 million US this year compared to $2.1 million last year and almost $3 million the year before. It looks like they're outsourcing more of this work, which is helping them save money. Now, this is where it gets really interesting. The company had some preferred shares and convertible loan notes. These are like special financial agreements that can change in value. For their preferred shares, they reported a gain of over $4 million US this year. That sounds good, but last year it was a similar gain. The company says that all these preferred shares were converted into regular shares around December 2024, so this won't be a factor going forward. On the flip side, their convertible loan notes actually caused a loss of about $639,000 US this year, following past losses too. These were also converted into regular shares in December 2024, so that's another item that should disappear from future reports. Let's look at cash. At the end of March 2025, they had about $3.1 million US in cash. That's a huge jump from just $76,000 US last year. This big increase is thanks to their IPO in January 2025, where they raised over $10 million US. This IPO definitely gave them a much needed cash infusion. However, even with the IPO money, their operating activities still used up a lot of cash, to the tune of $7.6 million US, which is an increase from last year. This just shows how expensive it is to run their business. And looking at their debts, it is good news. As of the 31st of March 2025, they had 0 outstanding loans from their immediate holding company, Rhino Ventures. They paid off and converted a significant loan during the year, which is a big step towards financial health. A lot of their old debts, like preferred shares and convertible notes, were also converted into regular shares. Now, a bit about their structure to understand how they operate. Diginex itself is based in the Cayman Islands, acting as a holding company. Its main subsidiary is Diginex Solutions in Hong Kong, or DSL for short. This DSL, in turn, owns companies in the United Kingdom and the United States. So it is a multi-layered setup. A key document here is their amended and restated memorandum and articles of association. This basically sets the rules for how the company is run, and especially for companies from places like the Cayman Islands. It can mean their corporate governance practices might be different from what you expect from a US company. They have, for example, opted out of some shareholder approval requirements for issuing new securities. They also have an incentive plan, essentially for giving stock options to employees. This plan allows them to issue up to 5.4 million ordinary shares as awards. This is a pretty standard way for companies to attract and keep talented people. Looking at who owns the company, Miles Pelham and Rhino Ventures Ltd, a company controlled by him, are major shareholders. Together they own a huge chunk of the company, over 49% of the ordinary shares. This means they have a lot of influence over company decisions. The report also mentions around 23 million ordinary shares outstanding as of March 2025. Another significant shareholder is HBM IV Incorporated, with over 3.6 million shares. It's interesting to note that multiple other Hearst entities are linked to this ownership, suggesting a larger corporate backing. HBM IV Incorporated appears to be the voting power behind these shares potentially. Then there is Noma's Global Investments LLC SOP-C, which owns a large number of shares as well, and importantly holds a significant amount of warrants. Warrants give you the right to buy shares later, and these warrants, if exercised, could represent over 22% of the company's shares. This is a pretty big chunk and could impact ownership percentages significantly if exercised. Speaking of warrants, they issued a lot in connection with their IPO. There are these Tranche 1 through Tranche 6 warrants, all with different prices and expiration dates. Some of these are held by Rhino Ventures and some have been sold to Noma's Global Investments. For example, Rhino Ventures exercised some of their early warrants, paying over $11 million to the company. These warrants were quite complex, with exercise prices ranging from 5.13 to 12.3 dollars and expiry dates spread out over a couple of years. On the business strategy side, Diginex seems to be leveraging partnerships, especially with HSBC. They have agreements where HSBC refers clients to their ESG software, and Diginex offers discounts. This is a smart way to get their product in front of potential customers, especially small to medium businesses that HSBC works with. They've got similar deals with other firms too, which shows they're trying to expand their reach through collaborations. Their core business is in ESG, that's environmental, social, and governance reporting software and services. They offer products like Diginex ESG, which helps companies report on their sustainability efforts, and Diginex Lumen, which focuses on supply chain due diligence. While their customization services, which used to be a big revenue source, are bringing in less money. They're focusing more on recurring revenue from their software subscriptions. Of course, it is not all smooth sailing. The report details a lot of risks. A big one is their limited operating history and the fact that they are not yet profitable. They've been investing heavily in building their business, but there is no guarantee it will pay off. Cybersecurity is another major concern. They handle a lot of sensitive data, and a breach could seriously damage their reputation and business. They also face risks related to doing business in Hong Kong, given the complex relationship with mainland China and evolving regulations there. Being incorporated in the Cayman Islands also brings its own set of challenges for investors, making it harder to protect your interests compared to a US-based company. For instance, enforcing judgments from US courts could be difficult. There is also the ongoing issue with the Holding Foreign Companies Accountable Act. If auditors can't be inspected by the PCAOB, US-listed companies could face trading bans or delisting. Diginex states their current auditor, Yuhai LLP, is based in the US and is inspected, so they believe this won't affect them. However, it's a risk that hangs over many foreign companies with US listings. On the corporate governance front, Diginex Ltd, due to its Cayman Islands incorporation and foreign private issuer status, has opted out of certain NASDAQ rules. This means they don't need shareholder approval for all sorts of things, like issuing a significant amount of new stock, which can give management more flexibility, but might offer less protection to shareholders. For shareholders, a big risk is dilution. The company can issue more shares, which could reduce the value of existing shares, and then there is the potential for insider selling, which can also put downward pressure on the stock price. And for those hoping for dividends, don't hold your breath. The company plans to keep all its earnings to reinvest in growth, so any return on investment will likely come from share price appreciation. Looking at their financial tables, the one thing that keeps popping up is the conversion of preferred shares and convertible loan notes. These were significant liabilities that have now been converted into equity. For example, in the year ending March 2025, preferred shares worth over $5.6 million were converted. This is a big change in their balance sheet, moving from debt, like instruments, to equity. Similarly, convertible loan notes worth almost $5 million were converted. These were major financial juggling acts that have now been settled by issuing more company shares. And that brings us to warrants. The company issued a jaw-dropping amount of warrants related to their IPO, adding over $72 million to their equity reserves. These warrants are complex, tied to different tranches and exercise prices, and their potential exercise could significantly dilute existing shareholders. Fast forward a bit to subsequent events, and we see some major movements. Rhino Ventures sold a large chunk of its IPO warrants to Noma's Global Investments for a massive $300 million US, with a significant portion being a promissory note. This shows a lot of activity and confidence in the potential of those warrants. Then there are these big acquisition plans. They've signed a deal to acquire Resultix for a staggering $2 billion US, mostly in shares, with a significant earnout tied to future performance. Resultix is described as a leader in AI-driven customer engagement. If this deal goes through, it would be a massive transformation for Diginex, but it also comes with huge financial commitments and risks. They've also advanced $8 million US to Resultix already, showing they are serious about moving forward with this. And as if that weren't enough, they've also signed a memorandum of understanding to acquire Idra Cybersecurity, or Findings, for another $305 million US, again in a mix of shares and cash. This company focuses on cybersecurity and supply chain risk. It seems Diginex is aggressively trying to expand its offerings through acquisitions, aiming to become a broader tech solutions provider. On the leadership front, there have been some recent changes too, with Lubomila Jordanova appointed as the new CEO in January 2026, and Mark Blick transitioning to a strategic advisor role. So, what's the story here? Diginex is an ESG tech company that's been investing heavily to grow. They've recently gone public, raising much needed cash through an IPO, and they've managed to clean up a lot of their complex financial instruments by converting them into equity. However, they are still operating at a loss, and these proposed mega acquisitions for billions of dollars are incredibly ambitious and carry significant execution risk. They're betting big on growth through acquisitions and expanding their software, but the path to profitability is still a long one. The success of these acquisitions will be absolutely crucial for their future. What do you think about Diginex's aggressive expansion plans and their focus on ESG? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a like and subscribe to Corporate Decoder for more deep dives into the world of finance and business. And don't forget to join our Discord community. Link in the description for more discussions like this. Thanks for watching, and well, see you in the next one.